people have these unrealistic return assumptions. What we've experienced in the last 10, 15 years is definitely not normal. And if you believe in mean reversion, we are probably going to have a period of time like we have from 1929 to 1954 or 1969 to 1982 or 2000 to 2011, where the returns basically go to zero.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
All right, welcome to this episode of The Bull of Wall Street. My name's Talley Léger. I'm the Chief Market Strategist at the Wealth Consulting Group, and I have the pleasure of flying solo today with my old colleague and very special guest, Jared Dillian, editor of the daily Dirtcon. I love that name. Welcome to the show, Jared.
Hey, thanks for having me.
You know, well, it's our pleasure, but I actually wrestled with how to introduce you. I'm thinking, is he an ex-Lehman trader? Is he a famous newsletter writer, author of several books, or a DJ? I guess it's all of the above, right?
It is all the above, yeah.
We could add founder and principal of Armington Capital to the list, but we'll get to that in a second. I reached out to a mutual friend, Frank Capillari, over the weekend, and my first question here for you is inspired by him. He's coming on the show soon too. He says hi, by the way.
Okay, yeah, Frank's great.
He's awesome. He wants to know. Inquiring minds want to know. What did you enjoy more? Was it your final Dirtcon conference at Myrtle Beach last May, or your DJ performance at Omnia in Vegas last Friday? And I want to know about that last one because I saw the social posts and they were fantastic.
Yeah, that would have to be the DJ gig at Omnia. Yeah, I mean, I like doing my conference. Actually, the conference that I do is for subscribers, and I've done 6 of them over the years, and they've grown and grown and grown, and we outgrew the space. So we're doing it in Nashville next year at the Virgin Hotel, actually this year in October, and it's going to be a bit bigger, so I'm excited about that. But the conferences are just a lot of work and stress. Playing at Omnia in Vegas, it's the biggest club in the country. There were 2,000 people there. If I had my way, I would just do that for the rest of my life. So,
Well, you made it, right? That's the true sign of the times, and understood on conferences, because we do a big one every year. We've got Collaborate coming up in April, but I hope I get an invite to your next show, man.
Yeah. I mean, I publicize it. You know what I'll do? I have a music mailing list. I'll get your email. I'll put you on my mailing list, so you'll get a heads up for the next. I have a couple gigs coming up. I'm playing in Nashville March 5th at a club called Night We Met. That's my next big gig. So you're welcome to come to Nashville. So, well,
thank you so much. By the way, how many subscribers do you have now? Is that for the Dirtcon?
Yeah, somewhere between 3,500 and 4,000, probably closer to 3,500. Yeah.
That's a good number.
Yep.
I remember when you launched that, but I get ahead of myself. So let me just say, I wanted to host you on the show here, not just because we overlapped at Lehman back in 2008, but rather it's your focus, I think, on things like risk management, sentiment and positioning, and market narratives. And all those things are super important for me and us and in our work. But I think most importantly, it aligns very well with helping advisors and their clients navigate uncertainty, which I think is really important in this market environment. So maybe I can just kind of pivot here and segue into some market questions for our advisor audience, and I'll start with the structural, because we already touched on Lehman Brothers there, but maybe some lessons from crises and our mutual experiences there. So having lived through Lehman Brothers and the collapse from the inside out, what warning signs do you think people always miss before those types of major market dislocations?
Um, it's funny because I started my career in 1999 as a local on the Pecos Options Exchange, and I started at Lehman in 2001, and left Lehman in 2008 at the bankruptcy. And so you have to think about this. Like, I started my career in 99. I lived through the dot-com crash. I lived through the financial crisis. Within the first 10 years of my career, I had two 50+% bear markets, right? In the first 10 years of my career. So, after living through that, you kind of go around looking for bear markets all the time. Like, it's just in your DNA, like it's happened twice in 10 years. It's going to happen again and again. And it hasn't happened. 2008 was really the last recession that we had. I mean, aside from the one in the pandemic, but I don't even really count that one. So, we've had an 18-year expansion, more, pretty much uninterrupted. When I look around now, basically I look for imbalances. I look for things that could be structurally wrong with the market. And one thing I'm looking at is private equity. And that's not really an out of consensus thing to say now. But when I started looking at it 2 years ago, it was an out of consensus thing to say. So, I look at possible dislocations that could happen because of a liquidity crunch or stuff like that. I think, right now the market, with concentration being as high as it is, a lot of people look at concentration, and in previous bull markets, you've had concentration get really high. I mean, I think the Mag 7 is 35-40% of the S&P.
Right.
I don't think that's necessarily a precondition for a bear market. I think it's one of those things you pay attention to, but it doesn't mean that a bear market is imminent, So, those are sort of, I'll shut up. Those are sort of the things that I look at.
So no, thanks for your comments. We actually have a very similar career span, because I started studying financial markets, money banking in the financial system back in 98. And my career really started in 2000. So I know exactly where you're coming from, man. I consider myself lucky to get a job back then. Yeah, because the NASDAQ peaked in March of 2000, and I got my job when I graduated in September. So that was almost impossible.
You were the last one in.
The last one in, right?
Yeah.
Defied the odds.
Yeah.
But no, your comments really resonate. Do you think crises come? And by the way, Mike Green is a friend of the show, and personally, I've been to his conference. He's been on the pod, and he shares similar concerns as you about private markets. You said equity. He's more so on the private credit side. That's where, and I think that's a fair comment as well. But do you think crises come from, and you touched on a few of these, leverage, liquidity, or loss of confidence, or maybe it's all three?
It's leverage and loss of confidence. Liquidity, I guess it's liquidity too, but it's really leverage. And if you think about the difference between the dot-com crash and the financial crisis, the difference was really leverage. Like, the financial crisis was much worse because there was so much leverage in the system. Right. The dot-com bubble was really an equities only phenomenon. And
Right.
to the extent that there was any leverage, it was just Reg T margin, so 2-to-1 leverage. In the financial crisis, financial institutions were levered 30-to-1, 35-to-1. You had similar, implied leverage throughout the mortgage markets. So, it doesn't take much for the equity to disappear, and then, then liquidity dries up and you have a loss of confidence. So I think it's all those things. It's funny you're bringing up like crises because the S&P just hit 7,000 today, and there doesn't really seem to be a crisis in the near future. I'm not necessarily preparing for one. I'm actually I don't. You might be surprised to know this. At the moment, I only own two U.S. stocks. Um, and everything else is international. I have a huge amount of international exposure, emerging markets, and commodities, and that's basically my portfolio right now. It's been that
Impressive.
way for the last 2 years, and obviously last year it worked a little bit, and this year it's working a lot. So
Well, so we've been moving, it sounds a little bit similar, the needle on our exposure to small cap and international pretty vocally and visibly, and that has been helping. And look, this market to me, it's not just about the seven biggest growthiest names. We are, I think, to your point earlier, we are seeing a welcome broadening in markets, and that really
international small cap value was up 46% last year, and nobody knows about it. Nobody knows
stealth
about it.
stealth rally. Yeah,
Yeah.
100%. But on the other side, I think as a stock picker, and we have a quant stock selection model that beat the S&P because it's mostly US focused. We have some international names, but it beat the S&P by 15 percentage points. I'm not exaggerating. So in a highly concentrated market, you can still add alpha by being really specific and company focused.
Yeah, I mean, my guess is that model is pretty concentrated. It's not. It's probably 15 to 20 names. It's probably not 200 names. Is my guess.
Right. It's not 200. It's closer to 60 to
60.
70.
Yeah.
Absolutely. Yes. And it's very rotational. We don't have any problems, trimming and taking profits. We've been taking a lot of profits just to right size positions and manage risks and the like. But I wanted to ask you, this is my last crisis question. I promise. But I just thought, we've been through so much in our careers, and we overlapped. I thought it was a good place to start. But what you said is really, really important. And I think when I think about the differences between, and you went through some of them, 2000, 08, 09, and today, the deleveraging that we have seen, especially on the part of households and businesses, has been a stark contrast. So I wanted to ask you, do you think, are we in a fundamentally different market regime than the post, well, I would say maybe the pre-GFC era, or is that just kind of one of these other market narratives we should avoid?
Well, you kind of have to look at where the leverage is. And you mentioned Mike Green, you talked about private credit, and that's absolutely true. Private credit right now is about the same size as the high yield market. And the funny thing is that high yield has become higher quality because all the low quality stuff has ended up in private credit. That's really where the leverage is. It's a $1.7 trillion market. It's pretty big. So yeah, that's and even within private equity, there's leverage upon leverage upon leverage. So that's really where I'm looking for the next crisis. And I think I started writing about this in like December of 23, maybe, and here we are 2+ years later, and it's showing cracks. But yeah, who knows when that's going to happen.
Exactly. Well, maybe that's another good question to ask, because yeah, we kissed 7,000 on the S&P. That was actually our target for last year, so we got pretty close. Little bit early, but not too shabby. But I wanted to ask you, like, given that stocks are here now at all-time highs, how do you personally think about risk management? That's something we touched on earlier in the conversation. When markets appear calm like this, does it even matter, or does it matter more?
Well, one of the things I always write about in my newsletter is that you should buy protection when you can, not when you have to,
Mm.
right? So the best time to buy protection is in periods where the VIX is low, the markets are calm, and really there's no compelling reason to buy protection at all.
It's
Like
cheap.
that's the best time to buy it is when it's cheap. And I'll tell you a quick story. Um, I did that in November of 2019, and the VIX was down to about 11 or 12. S&P vol was very cheap, and I said, you know what? I'm just going to buy some crash puts, like a very tiny amount. I spent like $2,000 in premium on some crash puts, and the pandemic happened 3 months later, and that $2,000 investment went to $76,000. So, so like that's the lesson I always have is, buy puts when you can, not when you have to. And nobody learns that over time. Like people make the same mistakes over and over again. Um, so yeah.
No, that's awesome. Thanks for sharing that, and keep the stories coming, because we love the stories. Maybe we can go in so many different directions, but maybe we should touch on the Fed a little bit here. And you can correct me if I'm wrong, but it seems that you've been critical of how investors interpret the Fed. And I guess my question to you is, what's the biggest kind of misconception that advisors should correct with themselves and their clients when it comes to the Fed?
Well, the thing to understand about the Fed, and look, like, I've done pretty well in my career trading short-term rates. When I started at Lehman, I was doing index arbitrage, which is really a short-term rates trade. I was trading a lot of euro dollars in Fed funds. I've always had an interest in trading short-term rates, did it personally for many years. And the reason I do that is because it's easier to predict what 19 bureaucrats are going to do than to what millions of market participants are going to do. And the one thing I've always said about the Fed is that they follow the path of least embarrassment, right?
Interesting.
So they're constantly in CYA mode, and if you go back to like 2020 2021 when inflation started to pick up, if you think about Powell's reasoning at the time, he did not want to raise rates even though inflation was ramping, because if inflation stopped and he raised rates and he caused a recession, it would be more embarrassing than if he didn't raise rates and then we got a little inflation. It turned out to bite him in the butt because we got 9% inflation, and it got way out of control. But that's the framework which the Fed follows everything. It's the path of least embarrassment. That's what they always do, because they're not profit motivated, right? The Fed has a P&L, but they don't care about the P&L. They're losing $100 billion a year and they don't care. So they're not motivated by money. They're motivated by reputation, right? And they work for the government, so it's they have completely different incentives than you and I do.
Yep. And ironically, and I like the way you said that, by the way, but ironically, the markets, as I think they usually do, did the Fed's job for it. And we had an exceptionally acute tightening in financial conditions back in 2022. And it felt like a recession because the market puked and earnings collapsed. For operators like us, it was a recession for all.
Yeah, and not only that, if you remember, the 60-40 portfolio went to hell.
Yes.
Because stocks were down 20% and bonds were down 20%, and there was really no place to hide.
No.
Even gold was down that year, so there was no place to hide. That was a very, very tough year. And I don't want, I hesitate to say we're going to experience it again. I'm not bearish on bonds, but probably at some point in the next couple years, we're going to have a rising interest rate environment again because of supply, because of treasury issuance. So
Interesting. Well, so I guess another good question to ask is, do you think, I think I know your answer already, but is the Fed truly data dependent or are they narrative dependent?
they're not really data dependent at all. And I wouldn't even really say they're narrative dependent. You know, the modern Fed is captive to politics in a way that I think, you know, the Greenspan Fed or the Bernanke Fed was not, you know. I mean, I'm not really saying anything new. Everybody knows that Trump is beating up on the Fed all the time. They're, and they're just captive to politics in a way that wasn't the case. Like I remember being, this is like 2003, 2004. And, you know, people used to pay a lot of attention to the ISM numbers, which were the NAPM numbers back
I
then. It was
remember.
National
Yeah,
Association of Purchasing Managers.
that's right.
It was the NAPM numbers. And really the rule of thumb for the Greenspan Fed was if the NAPM was above 50, then the Fed would be tightening. And if the NAPM was below 50, the Fed would be easing, right? And so the Greenspan Fed really, I think, was data dependent. And Greenspan had he had a long leash. He had served under Republican and Democratic presidents. Clinton kept him on after Bush, and you know he sort of had the latitude to do those sorts of things that the Fed today cannot. Like every decision they made is scrutinized from a political standpoint.
No, I remember that well. So I'm a kind of classically trained traditional strategist, an old dog that had to learn new tricks. And to your point, I mean, every cycle has something to teach us as investors. And I kind of had to recover from those lessons that the manufacturing cycle was the only thing that mattered. In fact, I wrote about this last year. I penned an article about the misleading indicator. The LEI from the conference board is another kind of notorious indicator, along with the NAPM or the ISM as you call it. So it's really interesting how markets evolve, and we have no choice but to change and evolve with them. But a question for you is, does that mean that monetary policy in this environment has limited signal or predictive power?
What do you mean by predictive power? Um, Let me think.
If you're thinking about it this way, you know, if inflation's a lagging indicator and the Fed is lagging the lagging indicator, what are we doing wasting our time?
Well, I mean, that's kind of, I forget what Trump calls Powell. He's like the last, like he's always late or something like that. Um, you know, that's another difference between the Greenspan Fed and the Powell Fed is that the Greenspan Fed was very, very proactive. You know, they would act very quickly on incoming data, and today's Fed does not act until all the data is in, and the markets are already pushing them in one direction. Like you said, in 2022, financial conditions tightened a lot before the Fed even did the first rate hike.
Right.
So yeah, I mean, I forget what the original question was about monetary policy and predictive power, but yeah, I think it has negative predictive power now. So
That's fair. That's fair. Let me ask you, because this is really important for us in our process, and I introduced a proprietary sentiment and positioning indicator that I've used for decades. I actually started developing this back at Lehman Barclays. But I wanted to ask you, how can advisors practically use sentiment without turning into day traders? right? Because I think you can overdo it, and we're not trying to condone that type of behavior. We want them to be longer term. Is that fair?
Yeah. Advisors, advisors can mean a bunch of different things. It could mean somebody with a $6 billion book at Morgan Stanley, or it could mean somebody with 20 million at Edward Jones, right? So,
Yes.
there's a whole spectrum there. Um, I think that sentiment is really useful. Um, yeah, I could tell some stories about my mom's financial advisor, who probably
Please
has
do.
20 million at Edward Jones. But actually, I'll tell you the whole story. So my mom retired in 2011. Okay. And she had a career working in the substance abuse field. She was a counselor for many years, and she went on to run a small nonprofit. So when she retired, she had $400,000 at age 65, which, back in 2010 was a decent amount. So she gets this financial advisor at Edward Jones, and keep in mind it's 2011, so we're 3 years removed from the financial crisis. And I'm kind of, I'm kind of scrutinizing his decisions, and he says we're going to put you all in bonds, all treasury bonds, and this is 2011.
Yeah.
And I said to my mom, I'm like, this guy is acting out of fear. We just had the financial crisis. Like, you want to be in stocks. So she's the intermediary. And I said to her, I want you in all stocks. So she goes back
The
to the
opposite.
financial advisor, and she says, I want to be in all stocks. And the guy says, you're nuts. You're absolutely nuts. So we arrived at a compromise, which was she was going to be in value and dividend stocks. So she gets this portfolio of value and dividend stocks, and then 7 years later, the 400,000 is now 800,000, right?
Awesome.
So now it's like 2020, 2021, and I said to the financial advisor, we are going to de-risk. We are going to go into bonds, not treasury bonds, but like, short-term high yield credit stuff, but we're going to go into fixed income. And he's like, actually, I was going to suggest we get more aggressive. We should get a growth fund. We should get an aggressive growth fund.
Classic.
And so, I would say the typical financial advisor
Yes.
is not thinking about sentiment at all. They're not thinking about cycles. They're doing what's fashionable at the time. If and a lot of this is because their business. Look, like, if they have a client that's in bonds and all their other clients are in growth stocks and they're all making 40%, and the person in bonds is making 5%, they're going to lose those assets, right? Like, that person is going to leave. So they're constantly in a position where they have to follow what everyone else is doing.
Yeah.
Like, it's a very rare financial advisor to say, no, we're actually going to do the opposite. Trust me. Like, this is in your best interests. We are going to do the opposite of what everybody else is doing.
So that's why we encourage our advisors to adopt the models that we run, because of the institutional style that we've adopted. And like you're saying, we like to zig when others are zagging. Back in April, man, we were shopping the sales hard, especially in tech, small caps, and consumer discretionary. And all those are some of our top positions to this day. It's amazing. So having a framework and indicators and a discipline and sticking to them, no matter what people say, it's harder. I think it's harder to do than say, but not impossible. But maybe
it takes courage. It takes
yes,
courage.
yes, well said. Well, maybe that's another good question. So what kind of behavioral mistake, and maybe you already answered it, do you see most often during bull markets like this? Is it the chasing?
It's the chasing for sure. Like, we've had some spectacular years. Like, last year in the S&P, I think the S&P was up like 17%. I think it was up 20+% the year before.
Yep.
What's interesting is that we've had so many good years that the 100-year average return of the stock market is now 10%, right? Like going back to 1926, the 100-year return is now 10%. And going back to 1972, the average return is 11%. So people have these unrealistic return assumptions about what the S&P is going to what the stock market is going to return in the future, like in the very recent past we've had 17%, 20%, 19%, and people think that's normal, right? People think that's normal. What we've experienced in the last 10, 15 years is definitely not normal. And if you believe in mean reversion, we are probably going to have a period of time like we have from 1929 to 1954 or 1969 to 1982 or 2000 to 2011, where the returns basically go to zero. And we have a period of a decade or more with zero-ish returns. Like that is going to happen at some point, Right. I'm not saying we're going to have a 50%, a great bear market, a 50% bear market, but the returns that we've had in the last 10, 15 years are not sustainable. And the way I think about this is, you have to think about the conditions that led to those returns. Right. And what were those conditions? Private property, rule of law, entrepreneurship, low and stable tax rates. And you have to think about, are those conditions going to be present in the future? And I don't think they are.
So it's fair. This is a question that I get constantly, and this is one of my big pet peeves and probably one of the largest misconceptions or misunderstandings in the marketplace. How to treat valuations. What do you do with that information? Yes, the stock market is overvalued here in the US. International is the opposite, right? They're kind of two ends of the same investment spectrum. But to me, and this is me putting my quant hat on a little bit, just because a market is trading at 26 times doesn't mean it's necessarily going to have a bad year in 2026. I wrote about this a couple of weeks ago, right? When you've got an underlying earnings growth rate of 15%, all of a sudden that PE actually looks below average. That's the PEG ratio we talk about. But when you consider what starting valuations mean for stock market returns 1, 3, 5 years hence, there's really not much of a relationship there, right? It's not a short-term timing tool.
It's a long-term timing tool. It's a long-term timing tool.
100%. You went there immediately, right? So you can actually optimize the R squared, and it approaches 90.9 over a 15-year holding period. So you're absolutely right. When we buy stocks at that high price, you're kind of robbing Peter to pay Paul, but the price tag doesn't really come due until 10, 20 years down the line.
Yeah. Yeah, I just, I mentioned earlier in our talk that I only own 2 US stocks and I own a bunch of international stuff and other stuff. Like, I guess one of my pet peeves is, a lot of people are very unsophisticated and their whole universe just revolves around US stocks, and they don't have any interest or curiosity about other asset classes, other international markets, commodities. There's a lot of stuff out there in the financial markets other than US stocks. And if you look at those periodic table returns, like, have you ever seen those things? Like those, I'm always interested in the stuff that's at the bottom of the periodic table. Like, what has returned the lowest in the last couple of years,
Yeah. No, I'm with you. Well, so that's probably a good question. I have my own view, but I want to hear yours. Given the tug of war between fear and greed, and I'll be honest, right? The reality is we fight this battle constantly. Most of our advisors have that perennial domestic bias or allocation, and so we actually have more international exposure relative to our peers. At least that's what our asset management partners tell us. So we're trying to, do a better and better job there. But at this stage of the market cycle, what do you think is most dangerous? Is it fear or greed? It's kind of a trick question.
I think it's greed. In addition to all the other things I do, I teach at the university level. I teach finance. Um, And I had a student who was a pretty good student, and he wanted to meet with me and get some career advice. And we were talking about stocks, and he's like, "Yeah, I have a Robinhood account." I'm like, "Great, what do you have?" And he says, "I have Nvidia and Broadcom." And I'm like, "Great, that's a very diversified portfolio." But like that
We
probably
own those names too.
that portfolio probably looks like a lot of people's portfolio in the US, right? Like,
Yes.
so that's the stuff I worry about.
Well, so I guess the trick to the question was it really depends on the market segment or asset class. Like silver right now, I would not be chasing. I think that's an example where greed is probably dangerous. But in equities, I think fear would probably be dangerous. And and the reason why I say that is I'm still seeing structural signs of fear in the marketplace, given the cash mountain on the sidelines. You know what I'm saying? Like we've got, I guess it's 8 trillion at the very least in cash in money markets and the like, and yet the stock market just keeps powering ahead. You think that's a fair way to think about it?
I'm definitely open to that. I mean, look, like let's say we're in a bubble, right? Like which maybe we are, maybe we aren't. This could be 1997 or 1998, you know. I can see a scenario where Rick Reeder becomes, we both know Rick Reeder, right? Rick Reeder becomes Fed chair, and Fed funds go to 0.5%, and the stock market goes up 30%. Like I can see that happening. So I can't.
Happens to be my kind of central scenario for stocks. So that's why we're kind of top of the street. In fact, we are top of the street with our forecast. I'm surprised you didn't bring that up, but but again, the targeting exercise is really mostly, I would say, a marketing mechanism. It's a useful way to get people's attention, and this is going to kind of get into questions about forecasting. But I use it very carefully. I think it's a great way to get people's attention, but also it's a useful mechanism for expressing your optimism or pessimism, and this is how I kind of treat it. A way of showing people your process and your framework and the dimensions that you kind of work through to get to outcomes in a scenario based, multifaceted manner. You know what I'm saying?
Mm-hmm.
So maybe we'll just go right there. So I know that you often argue that forecasting is overrated. I have to do it because that's part of my job. But what do you think advisors should focus on instead?
I don't think advisors should focus on forecasting. Your typical financial advisor has no ability to forecast. So I don't think they should focus on forecasting at all. What I think they should focus on is diversification across asset classes.
Yes.
Right? Not just stocks. So, the typical retail investor will buy an S&P 500 index fund, and they say, look, I'm diversified. I own 500 stocks. Like I have the ultimate diversification. You are not diversified at all. At all. And now, you might have been able to say that in 1997 when indexing was 2% of the market. But when indexing is 56% of the market and 100 million people are in the same trade, you are not diversified. So then you have to look at fixed income. And then you have to look at international equities, international fixed income. And then you have to look at commodities. I have a book coming out in September called The Awesome Portfolio, which is about diversification across asset classes. And what you find is, this is basic portfolio theory. If you take something with a low correlation or negative correlation to the stock market and you add it to the portfolio, the volatility of the portfolio comes down, right?
Yes.
So you're not trading off much in the way of returns. You might even be adding to your returns, but you're not trading off much in the way of your returns, and you're reducing your volatility, right? And volatility is the enemy. The S&P 500 on average will move about 15% a year, right? And we as a country we are crazy. We are crazy gamblers because we take all our money and we take our retirement savings and put it in this thing that moves around 15% a year, something that can go up or down 30 or 40% a year. And that's our retirement savings. No other country does this. They don't do it in Europe. They don't do it in Japan. We are the only people that do this. And here it's just normal, right? And so the argument I've been trying to make for years is no, diversify across asset classes.
Mm-hmm.
You're going to lose 100 or 200 basis points in return, and you're going to cut the volatility in half.
Right.
And that's what you should do.
Well, look, that's well said. And it resonates with us because in the wealth management space, and we have plenty of clients like your mom, it sounds like you can't just, be a strategist and, make a bullet call and put everything, all the chips on, on the table on that one horse. It doesn't work like that. You've got to run balanced, well-rounded portfolios. So I think that makes a lot of sense, Jared. But I wanted to ask you about that book. So the books that I know of are Street Freak, All the Evil of This World, and Those Bastards. Is this your fourth book you're talking about?
This is my seventh book.
Oh,
so
man.
After Those Bastards, I had No Worries, How to Live a Stress-Free Financial Life. And then after that, I had a short story collection called Night Moves. And then after that, I had an essay collection called Rule 62. So this is book number 7. Yeah.
That's awesome. And what's the name again?
It's called The Awesome Portfolio.
The Awesome Portfolio. I
Yeah.
might pick that one up, buddy. All right, cool. You got me by 6 books. Let me ask you about market narratives, because I think that's a big theme for us here. What do you think is a super popular narrative in the marketplace right now that's likely to end badly?
Narrative. Well, I mean, it's funny you brought up silver. Silver is getting very speculative. I mean, the trading volume is massive in, silver and silver miners. But the interesting thing is, I've been looking at metals for a long time, and I think it's mostly supported by fundamentals, by the supply demand dynamics of silver and gold. Like, even though it's gone parabolic, like in markets overshoot, I would have said that $80 or $90 silver actually makes sense. I don't think, there's a lot, Peter Atwater, who you probably know, he's a good friend of mine, and he's the ultimate sentiment guy. And he's on Twitter right now talking about how silver is, too much speculation. I don't think that's necessarily going to end badly. Like, it's going to have a big pullback at some point. But I actually think, I'll give you an anecdote. All the precious metals dealers in the country are seeing lots of customers come in to sell their silver and gold, right? Like, they've been keeping it in their safe in their house for years, and now the prices have gone up and they're coming out to sell. 97% of their customers are coming out to sell. That's not that's not how bull markets end, when everybody is selling, right? Bull markets end when everybody is buying. So that to me, look, there's a lot of volatility. There's going to be a big drawdown at some point, but I think that's got more legs to it.
Yeah, I think silver is over +2 standard deviations away from its mean. And the big event that I always remember is when the Hunt brothers cornered the silver market. And I think that bubble peaked in around 1980 or so. But this is an interesting comparison, and this is to your point about demand. I mean, we've basically got, it's not the Hunt brothers, but we've got three-pronged demand forces coming from the monetary, technological, and speculative kind of ETF dimensions, if you will. So it's not that it's not happening for, bad reasons. It's happening for the right reasons. But as you know, I think prices, and this is any market, not just silver, can at some point stretch too far from intrinsic value, if you will.
Yep.
But I wanted to ask you about this because I'm both an analyst and a storyteller, and I guess I might be a little different in that I allow the data to tell me the story before I get out there and kind of blow into the megahorn.
Well, that's not what you're supposed to do. What you're supposed to do is tell the story and then look for the data to support your story. Yeah,
that's right. Well, 100%. It reminds me of that famous quote from, is it Ronald, the economist, Coase, his last name was, if you torture the data long enough, they will confess to anything, right? That's the unscientific method, right? But how much of the, and that's, it's fair and it's funny, but how much of the, the market commentary that we write and put out there into the social sphere is analysis versus storytelling?
Well, analysis doesn't sell. Storytelling sells.
100%.
Yes.
Thank you.
Yes. So, and look, there's a certain kind of customer that does like analysis, right? And I really think the best financial commentary is a blend of analysis and storytelling, and that's really what I've been doing for the last 18 years, I like to tell people that I'm a better writer than I am an analyst. I've written 6 books. I'm an exceptional writer. I'm a pretty average analyst, but Ben Hunt has focused on narratives his whole career, right? Like narratives really matter, and if you're talking about like individual stocks, I kind of have a saying that if you can't sum up the thesis in buying a stock in one sentence, then you should probably not buy the stock, right? Like if it's some kind of tortured analysis and like all this data and, ratios and stuff like that, it's too complex and it's not going to work. Like you should be able to sum it up in one sentence.
Absolutely. I mean, if you can't, then you don't really know, right?
Yep.
That's if you can't explain it to a 6-year-old. So I don't know if you remember this, but back at Lehman Barclays, I used to send out these quick heads up emails. It was one chart and a few sentences, and it was like gold. Everybody wanted to be on that kind of quick hit list or sizzle reel. And I pivoted to the buy side. This is second half of my career. So I just kept swimming upstream. And I've been on the receiving end of volumes of like high volume, low quality research from the sell side. And they're not doing themselves any favors, right? It's what we're just talking about. When you've got oversupply, what does it do to the price, right? It's kind of worthless. And so I just kind of gravitated, and I kept with that. So I put out these market strategy flashes. They're super short, right? It helps ease the cognitive load. And you're actually sitting as a specialist telling your audience just the things they want to know, like the 3 key things or whatever it is, the 5 key things. And here's the chart, and I'm in and I'm out. And that's it. Get known for that.
Yeah, I think JP Smith used to send me your stuff, if I remember correctly.
Yeah, he's awesome.
Yeah, I haven't talked to him in many, many years. Yeah, I mean, there's a media outlet called Axios, that really capitalized on that. Axios came up with this idea of smart brevity, right? So they said, we're not the New York Times. We're not going to write this, super high Flesh Kincaid article about, the riots in Minneapolis. We're going to write it in 200 words, right?
So smart. Yes.
So we're going to tell you what you need to know, and that's it. And if you want to learn more, there's a link, right? So
Absolutely.
Axios, I think they sold for like 300 million or something like that. Like they were very successful with that, So
well, so to your point at Invesco, I was a thought leader at Invesco for a long time, and that's exactly that whole structured and framework is entirely how we modeled our rapid market responses to events that are kind of going on, and have the conclusions right up front. Don't make them read through a 100-page tome to get to the last sentence and the conclusion at the bottom. So yeah, the book reports, I'm sorry to say, Jared, are long over for me. Maybe one here, kind of a closing philosophy for advisors. What would you give? What kind of advice would you pass along to our audience, trying to cut through the noise and stay intellectually honest with their clients, and clients being the Mr. and Mrs. Joneses of the world?
Yeah, I mean, it gets back to what I said before about courage. You have to be brave. You have to be brave and do something different, and you have to risk the relationship in order to do the right thing. For example, S&P's at 7,000. Everybody's in growth and tech funds, right? So, a lot of advisors' philosophy is, well, if all my clients lose 30%, they're all losing 30% together, so misery loves company and nobody's going to fire me, right? But you shouldn't think of it that way. The first goal of an advisor, it's like the Hippocratic Oath. It's like, do no harm. Like, don't lose money. That is the goal, And I'll say something else. Like, a lot of mass affluent, middle class-ish sort of people are very careless with their money, right? If you have 400,000, the goal is to make 800,000, right? Mm-hmm. But if you have somebody who is very wealthy, let's just say you won the Mega Millions, you won $200 million, right? And I go to you, how are you going to invest $200 million? You're not going to try to turn it into 400 million. The goal is to protect that wealth, right? And to minimize losses, right? Like I said, the Hippocratic Oath, do no harm. So I see a lot of, like I said, mass affluent people taking outrageous risks with their money, which is facilitated by their financial advisors, right? And I think the amount of risk that people are taking in general is too much. I think they should be more conservative.
Well, that's well said. I for one, would wish that the Fed would be forced to take the same Hippocratic Oath. But I'm so glad that we reconnected and you agreed to come on the show with a wealth of insight. Jared, Dillian, I will give you the last word. Is there something that we haven't opined on that you'd really like to bring out in the conversation here?
No, I'm not really a last word guy. Just if you're in Nashville on March 5th, come out to the club. Come out tonight. We met. Follow me on Twitter at Daily Dirtnap. That's a good place to follow me. And if you want to subscribe to my newsletter, it's the Daily Dirtnap. Go to dailydirtnap.com. If you mention this podcast, then I'll give you a huge discount. Here's Three's Company too. Come and dance on our floor. Take a step that is